taking a look at that market action with Peter Armitage from Anchor Capital. Peter, a pleasure. Good afternoon. All right, I think for Peter, batting to hear you there. Is your mic unmuted?
Yeah, I'm unmuted.
All right,
can you hear
brilliant.
me?
Awesome. Thank you for being with us, Peter. Green screens all around, a strong rand. Let's talk about what we're contending with this afternoon.
Yeah, I think things are feeling generally pretty good out there. I think the big banks and what they deliver and what they say about the economy really counts. This morning you've had Standard Bank coming out with not fantastic earnings, only about 4% up, but that is largely due to African currencies. But a much more bullish and positive outlook and message than we've seen for a long time. So globally, we had a panic a week or two ago. The market came off between 5 and 10%, depending on which markets you look at. But that's tended to bounce back a bit. US inflation, which is the key metric around the world, coming in below 3%. So there's quite a bit of feel good out there on the local markets. People still deciding whether the government of national unity is going to work, or are there risks to it? I saw Floyd Shivambu's just resigned from the EFF. I'm not sure what to read into that from a political and market perspective. US futures are up a little bit. So it's, interesting times.
It is still volatile times, though, isn't Peter? I mean, part of me feels like we could end off next week speaking about, another sell-off and more jitters. Or are we at a point where we're understanding that, the conversation is around a soft landing, a hard landing, that, inflation is coming off, interest rates will certainly be cut, and that picture a little bit more certain for the markets?
Yeah, so I think what's quite interesting is when the US market had a bit of a panic a week or two ago, the local market hardly budged, which, it's interesting dynamics. And they are a little bit separated at the moment. Obviously, South Africa operates on the global stage, but you've got record high valuations, or close to, in the US, and very low valuations in South Africa. So certainly we think that there's more upside potential from South African shares. And an interesting dynamic is bond yields have come off quite a lot in South Africa. Mm-hmm. We had about 20 or 30 billion rand of inflows into our bond market this year, but we haven't yet seen that in the equity market. So, the guys are unemotional about it, not looking at company level. Our bonds are fairly cheap. But I think there's still, from global investors, a kind of wait and see in the South African market. But because they aren't as present as they usually are, when the US market got hammered a little, SA was fine. So, we're still sitting with South African shares at, you can buy lots of quality companies at 6, 7, 8p multiples. In the US, anything that's got decent growth prospects is trading at a 20 or 25p multiple.
Sure. Very interesting perspective you gave us there, Peter. I also want to speak about the Chinese market there. We saw retail sales come in, growing a little bit better than expected. We know that consumer confidence, a huge issue in China right now. We've seen some earnings emerge from global companies showing that China just isn't spending the way, many had anticipated. I'm wondering if we should even be bothered with, this kind of retail sales, or if we should wait to see a longer-term trend before concluding that consumer confidence is on the up.
Yeah, China's really battling to get out of the property hole that's developed. Property development, a lot of guys have lost their money out of developers who've gone bankrupt, results in people holding back. So lots of write-offs, write-downs. And the Chinese government hasn't reacted as aggressively as they do normally. I think they're kind of waiting for things to normalize. But China is ultimately a fairly big driver for the South African market, arguably more important than the SA economy, given the presence of Naspers and the commodity companies on the SA market. So it's important. The retail sales weren't great, but they weren't a complete disaster. But I think it'll take quite some time for China to work its way out of the mess that it's got into in terms of property overbuilding.
And speaking about economies that have been battling, the UK also, we saw that economy grow by 0.6% in the second quarter. It really isn't, I think, it isn't enough, I think, to see, that show some sort of a market rally. But it looks like markets have received it well. I'm just wondering about the state of this economy as a whole. And if, it gives confidence to equities, even in that part of the world.
Yeah, so, the UK has got its own specific problems, but it's tied into the European economy. But what you're seeing globally is America growing at well above the 2% level, but Europe well below the 1% level. And the UK, with Brexit, they really shot themselves in the foot. I don't think they understood the economic implications, so they've made it more difficult and more cumbersome for businesses to develop there and for companies to export. Um, so it's, yeah, the UK, I think, is in a slow growth mode for quite some time. But you must remember that, interest rates are pretty high in Europe and the UK. So we've had the first interest rate reduction in the area. And that should help build up and stabilize the economy over the next few years. So the global economy in aggregate, we're looking at about 3.2, 3.3% for this year and next, which is pretty reasonable, but it's not evenly spread. You've got lower growth than normal coming through from China, higher growth than normal coming from America. But America now that's the next question, and that's why you saw the market come off 2 weeks ago. Morgan Stanley came out today saying a 41% chance of a recession. But if you look back a year ago, every single big investment bank was predicting a recession by now, and the economy is absolutely flying. So there's the ability, it's remarkable, the last few years, the ability of our community to forecast economic conditions has been severely put into doubt. What you do know, valuations, those are factual. Interest rates, those are factual. So, the positive from an interest rate perspective is the gun is loaded. Interest rates are at very high levels in America, and you've got the potential to stimulate the economy. And they haven't felt the need to do that for quite some time because it's been so strong. So, that's the kind of dynamic that you'll hear talked about every night on Bloomberg is when do interest rates come off and how fast and the like. If you look historically, every time interest rates start coming down, they come down faster than people expect. If you look at the last 20 years, most people are forecasting a fairly slow move, but I think once they've moved in one direction, you'll see those come off. And that, there's a lot of people paying a lot of interest or under a lot of pressure because of interest rates. And I think there is a risk that they're moving too late. And a lot of people, if you're sitting with a picture yourself, you're paying your house bond, you haven't got any excess cash to spend because it's gone up 3 times over the course of the last few years. Eventually you reach a breaking point. So I think they need to stop pushing so hard. Interest rates in America, it's above normalized levels. It's in the restrictive category. And that 5.25, a normalized level is probably 3 to 3.5. And we'll follow that journey over the course of the next 6 to 12 to 18 months.
Peter, I want to talk also about Standard Bank and speaking about interest rates. They've come out, you said headline earnings up 4%. It's not, of course, the best performance here, but that return on equity up 18.5%. And they've also managed to reduce the credit losses. I'm just keen to get your thoughts on the set of numbers coming out of the Big Blue.
Yeah, so I think all of their businesses in aggregate in constant currencies all grew kind of 10% or more in pretty tough conditions. So that's quite good performance. The number of clients went up by 5%. I think the number is about 19.5 million. Interestingly, Capitec have got about 21 million clients. So Standard Bank throughout South Africa and the rest of Africa have got less than the startup of 2 decades ago. The return on equity is good, so I think the business is being well managed. And from a credit loss ratio, so that's the amount that they provide against their debtors book in terms of bad debt provisions. I think the way accounting rules changed, banks had to be a lot more kind of forward-looking, and there were quite big credit loss provisions a year ago. So they've got quite a bit in the kitty, so to speak. So they didn't have to, they could actually provide a little bit less this time to keep the kitty the right size in providing against the bad debts. So it was expected that credit loss ratios would peak kind of 6 or so months ago. So that's a nice positive driver for the bank going forward. Ultimately, for banks which are in the business of taking their capital borrowing yours and lending it out to other people. The key metric is the return on equity, and that looks pretty solid at 18.5%. You know, if you were able to get an 18.5% return on your capital, you'd take that every day. So it's, as long as they've got the ability to continue to lend out capital and kind of continue to achieve that rate, there's fairly good, you know, solid prospects over the next while. And our banks are very cheap. You know, you can get dividend yields between 6 and 9% on the South African banks.
Well, that's it, Peter. Which counter are you loving this afternoon?
Which counter am I loving?
Yes.
Well, you know, one we've liked for a long time. It's not a steal. It's Estadio. They've just come out with results. They sit with a very high quality long distance business, and when your biggest competitors are Unisa and Damlin, which are really battling to, you know, to maintain their credibility. We see them growing their customer numbers quite a bit every year, and it's a great business model. You know, you can picture distance education, you can double your number of clients or customers or students with probably only adding 10 or 20% to your cost. So it's about a forward 16p multiple, but that's a company we think can grow 20% quite consistently for quite a few years. And the trading statement indicates it's pretty much that for the period just ended to June. So it was a confirmation of what we thought. It's a good news story, so it doesn't come cheap. But it's one of those, I put some in my portfolio 2 or so years ago, put it away, and you know, every few months you look, oh, okay, they've actually done pretty well out of it. It's a compounder. It's a 5 Rand share. That's, you know, it's going to be worth 10 Rand in 3 to 4 years' time, with much lower earnings risk than a lot of other companies.
Brilliant, Peter. A pleasure having you today. Thank you so much for taking us through a midday market. So that was Anchor Capital's Peter Armitage.